The initial steps of buying a house can be scary and it can be stressful. And probably the biggest part of that stress is determining whether or not you qualify for a home loan. But I promise you, it doesn't have to be stressful and it doesn't have to be overwhelming. It's really just like following a recipe. As long as you follow all the steps and you don't skip any ingredients, you can get very clear, detailed answers on your home loan options and you can get them quickly. I've been a loan officer for 13 years. I've closed almost 1,000 loans and I've seen just about every financial situation you can think of. Everyone's going to be a little bit different, but the loan guidelines and the available loan products stay the same. And as long as a lender clearly navigates those programs and guidelines, then they can clearly determine your ability to buy. So first, real quick, let me make it clear that this video is not an attempt to convince you to buy a house. I believe that it's the right financial decision in the long term, but ultimately you're going to have to make that decision on your own. What this video is for is to teach you the steps that you'll have to take along the way of the home purchasing process, and also some of the pitfalls that you could run into and that others run into that could potentially be very detrimental to your ability to buy or can cost you a lot of money. Everyone's situation is a little bit different, but the loan guidelines and programs that are available remain the same. So as long as you are navigating those guidelines and those programs correctly, and really you rely on the lender that's assisting you with the loan to do that, you can ensure that you will have a smooth buying process. This is going to seem typical coming from someone like me, a mortgage loan officer who benefits from people applying for home loans, but it's 100% true. The first step that you need to take if you want to buy a house, unless you're paying cash for the home, is you need to get with a reputable lender and give them the information they need to issue you a pre-approval. Now, you may have heard this term pre-approval before, but what it actually means, I think, is a little bit vague to the consumer. So what it means, assuming that you're dealing with a reputable lender, is that they've reviewed your entire financial situation and they confirm how much you qualify for, what your monthly payment would be, how much you'd have to put down, and what loan programs will be most suitable for you. Now, a quick note on this, lots of lenders issue pre-approval letters to people, but that does not mean that the buyer is actually pre-approved for the home loan. So what happens is the lender will maybe take some of the necessary information that they need, but they didn't calculate it correctly or they didn't bother to take the full application. And so they issue that pre-approval letter hoping that it's all going to work out, but maybe they got something wrong. And maybe, for example, they pre-approved someone for a $400,000 loan when they only qualify for a loan for $350,000. So that can wreak havoc later on when you go under contract to buy a $400,000 home. So, I mean, it's just absolutely true that who you work with in this process matters, and your well-being is in this person's hands. Okay, so assuming that you are going to work with a good lender, what is that lender going to need from you in order to issue the pre-approval? So to get started, you'll usually have an initial conversation with the lender so they can get a feel for your goals, needs, and maybe your timelines. From there, they're going to need to take a full application from you. Now, that can often be done over a phone conversation. It can be done in person at the lender's office, although that's not really common these days. Or what's probably most common is you can fill out an online application from the lender's website. And that's usually most preferred because the online application software that's available these days is very user-friendly. It allows you to input all the info that a lender would need and upload any documentation that they need to support that information. And a lot of the times after you fill that out and provide that info, the lender's going to have all the info they need to finish a pre-approval quickly for you. In short, the information that you provide to the lender comes down to three major aspects. That's your income, your credit, and your assets. And especially for a primary residence, you don't have to panic too much on the assets because in a lot of cases, you can buy a home without showing any assets. Now, I'm going to break these three aspects down for you in detail. To be honest, though, you don't really need to understand all this stuff. You really just need to deal with that reputable lender who knows what they're doing so that they can work all this stuff out for you. They can take that application and let you know exactly what documentation would be needed. Okay, so regarding income, what the lender is most concerned about is what documented income can you show you receive, and how likely is that income to continue for at least the next usually 1 to 3 years? There are plenty sources of acceptable income that can be used to help you qualify for a home loan, but some of the more common ones are like regular employment, like W-2 income from a job where you get salary or hourly income or commission, that type of thing. Or if you're a business owner or if you're an independent contractor, child support and alimony. If you own any homes that you earn rental income on, retirement income is a very common one, like Social Security, pension, stuff like that. So those are the most common. Now, if you're employed somewhere, The most common documentation that we need are going to be like your last 2 years W-2s and 30 days worth of pay stubs. If you're a business owner or you earn any rental income, we'll usually have to verify the last 2 years of your tax returns. As a home buyer, here's one general aspect of income that you need to understand. A lender doesn't just look at your income over the last 2 years or last year and divide that by 12 months or 24 months and come up with a monthly qualifying income. It really depends on the type of income that you earn. So like if you're hourly, we have to see if your hours fluctuated over the last 2 years. If you're salary, that's pretty straightforward. We just divide that annual salary by 12. If you're a business owner, we have to look at what your business earned over the last 2 years, not just your gross sales, but your net income after all your deductions and all that. And we have to sometimes ensure that your business is not showing that it is in decline. If you earn rental income from other properties, we can't just use the gross rent that you receive. We have to account for any expenses that you wrote off on your tax return in direct relationship with that rental property. So the point is, because there are all these different ways that a lender has to calculate that income, it's just best to do the pre-approval with the lender so that they can verify those pieces of income. And then if they have all that information in front of them, they can very simply and quickly calculate your qualifying income according to the loan guidelines. Okay, so next, a lender has to pull a copy of your credit report. And to do a full, true pre-approval, yes, there has to be a hard inquiry on your credit. So multiple times per week, people ask me, do you really have to pull a hard inquiry? I don't want this to affect my score. And a lot of people are under the assumption that hard inquiry is going to lower your score 50, 100 points, but it's just not accurate. An inquiry can lower your score as much as 5 points, but it's absolutely necessary for that lender to do because they need that full, accurate credit report in order to run the file through their underwriting system and get you exact answers on what you will qualify for. Of course, a common question is, what credit score do I need in order to qualify for a home loan? And there's not just one answer. So typically, a 640 is going to be kind of a safe zone. Sometimes you can go lower. Sometimes you'll need to be higher. Obviously, it may not be obvious, but the higher the credit score you have, the better interest rate you're typically going to get and the cheaper the mortgage payment's going to be for you. One thing that angers me a little bit about how lenders market minimum credit scores is they can often be misleading because they'll say, we can do loans with scores as low as 580. And although that technically can be true within the loan guidelines, the important thing to understand is that that is the minimum, assuming there are not any other factors that would prevent you from qualifying for the loan. And you often need compensating factors. So some loan programs will allow you to put like 3.5% down and credit score as low as 580. But if you do have that minimum 3.5% down, you can't put any more. When the lender runs that file through with a 580 credit score through their underwriting system, it's often not going to approve it. So like a realistic scenario where that might work with a 580 credit score is they are using that program, and even though the minimum for that program, generally speaking, is 3.5% down, maybe they have the unique ability to put 20% down. So that would be a compensating factor where the underwriting system may approve the loan with the 580 credit score. But it's not real common, and you're often going to not have that great of loan options available to you at that score. The rate's going to usually be substantially higher and all that. Even if you can get up to 600, that's going to give you a lot better shot at having realistic options for your home loan. Beyond the credit score, the lender is going to look at what outstanding debts are showing on the credit report. So these are things like car loans, student loans, personal loans, stuff like that. And they're not so much concerned about what the total balance is that's left on the loan, but they're more concerned about what the monthly payment is going to be. So let's say you have a car loan with a $30,000 balance and a $600 payment. They don't care about that balance. They care about that $600 payment. This is where your debt to income ratio comes in. This is a relationship between your overall monthly debt and your overall income. So here's an example. Let's say your monthly qualifying income is $5,000 a month and the housing payment on the home you'd like to buy is $2,000 a month. And maybe you have a car payment of $400 a month. So in that case, your total debt would be $2,400, the housing payment plus the car. So we divide that into the monthly income of $5,000 and your debt to income ratio would be 48%. Generally speaking, that ratio has to come in between 43 and 50%. There are some programs that will allow you to go up to 55 and sometimes even higher, but that's the range where most people are going to fall in, between 43 and 50%. So if your lender's working on your pre-approval and they determine your ratio for a given scenario is at, let's say, 53% and the underwriting system's not approving that, the option would be to try to go down a little bit, and hopefully you wouldn't mind settling for a slightly lower home. Or in some cases, you can look at adding a cosigner, someone who earns regular income, has decent credit, and not a whole lot of debt. Next is your assets. So the lender is going to need to verify what funds you have available for down payment and closing costs. So your down payment is the amount that you have to put down against the home. Now, each loan program is going to have different down payment requirements. And again, this is based on a primary residence. So a conventional loan is probably the most common option. If you're a first-time home buyer, you can put as little as 3% down. If not, you have to put 5% down on a conventional loan. FHA will allow you to put as little as 3.5% of the purchase price. A VA loan available to military members or retired military, or in some cases, the surviving spouse of a deceased military member, is allowed to put no money down. And if you buy using a USDA loan, which qualifies in lower populated areas around the country, you can also put zero money down on that. If you don't have the means to put a down payment, you can ask your lender about down payment assistance programs. Many lenders and states will have these programs available to help homebuyers get into a home. You'll also have to come up with closing costs. These are standard fees that are associated with the purchase of a home. So these are things like lender fees, title and escrow fees, appraisal fee, HOA setup fees, first year of homeowners insurance, prepaid property taxes, home warranty, and there might be some other miscellaneous fees I'm missing just depending on the state that you're in. In some cases, you can get the seller of the home to cover part or all of your closing costs for you. And in some cases, you also can get the lender to provide you what's called a lender credit that can be applied towards your closing costs. Of course, nothing is given for free. That usually is in exchange for a slightly higher interest rate than what you normally would have gotten. Okay, so that's a general overview of the information a lender will need to review in order to issue a pre-approval. Now, sometimes a lender will just give you a pre-approval letter, and maybe they will give you information on like how much you have to put down and maybe a poor estimate of what your monthly payment would be. But going back to that reputable lender, what you need from the lender when they pre-approve you is not just that letter and some vague info. You need them to break down exactly what programs you qualify for, the dollar amount that you can go up to, what your minimum down payment would be, what your monthly payment would be, and part of that's estimated because it depends on like what the taxes and insurance would be for the home, but they should be able to give you a really good estimate of what that looks like. They need to give you a really good estimate of what your closing costs would be, so that way you can combine what your down payment closing costs would be. You can see how much you'd have to pay out of pocket and what you can expect to pay as far as the monthly payment and interest rate on the loan. Now, especially if you haven't ever gone through this process before, you may not think to ask about all this stuff. You may be so excited that you actually qualify for the loan amount that you need to purchase the home you want that you just get your letter and then you go start searching for homes. But it is very crucial that you have a strong understanding of all these figures before you go out shopping for homes. So if your lender is not giving you a very clear breakdown of all this information, you definitely want to ask why, and you may even want to consider switching lenders. As a new home buyer, I imagine that when you sit back and take in all this information that I gave you, it can be overwhelming. It seems like a lot. But again, it really does not have to be. What it all really just comes down to is the accuracy of your pre-approval and the ability for the lender to get that part right. Because let's say, for example, through no fault of your own, you chose the wrong lender. Here's how it could play out. You went to the lender, you filled out their full application, you gave them all the documentation that you needed to give. They gave you a pre-approval letter up to, let's say, $400,000. You went out, you shopped for 20 homes. You finally found a home after tough negotiations with the seller. Maybe you're working with a real estate agent. You go under contract to buy. That's usually a 30-day close. Now that you know you have a closing date, you give your 30-day notice to your landlord. You have to be out of your current rental within a certain amount of time. And then come to find out 3 weeks into the process, you have to close in 1 week. The lender got something wrong and the pre-approval was inaccurate and you don't actually qualify to purchase that $400,000 home. That is not a good situation to be in, and it all can be resolved by making sure that the lender gets the pre-approval done right the first time. So if you're thinking about buying a home in 2025 or even beyond, I always say, as soon as you realize that it is a goal of yours to be a homeowner, you need to get with a lender and start having the conversation. Even if you're not ready to maybe fill out an application and give them all your personal info, a 5-minute conversation with the lender can really go a long way in helping you determine the right path to homeownership. And if you want to see what you qualify for, or even if you just have general questions, I'm happy to help. So in that case, just click the link to book a call with me and we can get the conversation started. Also, I plan to put out a lot more helpful information to help homebuyers. So if you could, please hit the like button and subscribe to my channel, and I hope to see you on the next one.